Okay. Welcome you guys. Come back tonight. I know lots of you are still in the midterm exams, right? So uh, work harder. All right. Tonight we're gonna talk about the strategy report evaluations. As I guess most of you did attend the last workshop, so there's a lot of coding that you could try at home, and also I asked you guys to hand in your codes as well. I list out several requirements for you to list in your codes. So I did a little readings on your codes. I found some of you have some common problems, and also some of you did very well in the codings. I think that's good. At least you guys did try to code something that belongs to yourself. Because in the middle of the process, or when you coding, you would learn something that sometimes it's hard to teach because those teachers they would assume there's the common sense. However, for a newbies, for new beginners, from their perspective, there could be something totally brand new or something they just couldn't understand at all. So I think there's a good experience for you guys to have to build your first strategy. All right. Then same, we're gonna start with a disclaimer because we just want to ensure that what the content we talk about today would not form into any investment advice. All right, or suggestions. Okay, first of all, I see the groupings. The Excel contains the names and the groups of you guys. So for those recognize your own team, then please go to the Google Drive and maybe afterwards you will find the data that I put on the web on the shared drive, so you can download it. The right hand side tells you that, for example, for team one, they are interested in the commodity. Then I just assign the product gold to them. The exchange would be CME gold. So you just like last lecture when I teach you guys how to import those data into multi-trust. Just do the same thing. For those who forget how to do it, don't worry. We put the PDF of the last presentation of the last PowerPoint used in the presentation online, so you can find it and just copy the steps. Will be the same, totally the same. So don't worry about it. Remember to go search for your own products and trying to import it and see what's the result. Actually, one of the things that I expect you to try is just like last lecture, we use two simple, very simple strategy. Just simply break out the long side and the short side, right? Try to use the same strategy without modifying anything. I'm talking about not to modify those parameters. And of course, the commission you have to reset because it shouldn't be in HKD and $50 per point. And the commission shouldn't be $20 because $20 in Hong Kong is okay, but $20 as commission in USD is very expensive. So you have to adjust those figures accordingly. For example, if you want to trade, let's say DES is the German, at least in the German market, the index, right? The major index. Then when you're trying to trade its futures, it is more the unit is rather than be in Europe rather than USD. So you can estimate, for example, I would assume, let's say $1 or $1.5 would be a conservative and reasonable commission rate. So you can do this kind of transformation from HKD and transform into the currency it's going to use. So yeah, the rest of them just do the same thing. Don't worry about it. And by the way, just have to mention, Japanese yen, do remember use yen because when you use the original $20 commission in yen-based products, then your commission is very, very small. Okay, just talk about 20 yens. So, and imagine when you go to Japan, what can you get for 20 yens? Okay. All right. Then some findings in your assignment. First of all, I noticed some of you maybe mess up with the ideas of the loss in one trade versus what we call MDD, maximum drawdown. Well, actually, the maximum drawdown is, well, in English, is the latest peak of your equity curve. For example, when you start trading, you have an equity curve, right? Sometimes you win, sometimes you lose. It's just recorded in a graph. So that graph would be you take the latest peak of the equity curve minus the latest bottom, because sometimes it moves like this. You have to decide which one is the maximum. What drawdowns means lose money, okay? Very simple. But a lot of money losing period in the equity curve. You have to find the maximum of it. That is called the maximum drawdown. So I saw some of the codings in your assignment is that the homework. Some people just input, I want to do a stop loss trade. However, when I stop loss, I try to do a stop loss at 500,000, as I've mentioned previously. The MDD should 500,000. He just took or he or she, I don't know, just input the figures, $500,000 for the stop loss, which is wrong, unless you only trade once. Okay, so I assume this is not going to be the case. So trying to differentiate what means per trade, because what you write in the script is kind of like you expect the trade to what the strategy to perform, rather than you control the overall shape of the equity curve. So please pay attention to this. And secondly, when someone type the time, as I remember, one of my requirements is trying to close your position before 16:15, right? So some of you just input time equal 16:15, then do kind of some other thing. A little reminder, because when you use the 30 minutes chart, there's no such thing as 16:0 or that kind of things. So basically, I'll suggest you guys, because each bar is 30 minutes, okay? So when you're trying, without doing anything extra, this can be solved, but you have to do something extra. And that extra part, I'm not going to tell you right now. Maybe afterwards, I'll tell you how to deal with it. But in the simple form is that when there's one bar, 30 minutes for each bar, then actually the code will only be run only every first stroke. The code is run is 1600 will be the first time to run the script, and the next time will be 16:30. Then how do you exit in the middle? In your code is right now is impossible to do it. So I'll just recommend you guys to do it in a simple way. Just give a range of that time rather than a specific time, because when you input specific time, if anything happens, for example, when you're trading, suddenly the power goes out or the network goes out, then you will have problems liquidating your position. So try to use a range of time would be easier. And of course, you can use not just minutes, you can use seconds as well, but it depends the settings of your code. All right, so now we make it simple. We just assume within that 15 minutes, I think it's totally acceptable to close your position during the period of 16,000 to 16:50. I really see you guys actually some quite in response to the example. We're trying to doing an outbreak, then he's trying to outbreak add a little adjustment. It's a time 1.3 or 1.5. So basically, you have to output for more than 30%, then you initiate the trade. Rather than just at the moment when it outbreak, then you will end the trade. So I think this is a very good attempt when you're trying to modify something. And also another case I saw in the assignment is that some of you really did copy the built-in strategy. I think this is good. No worry, just copy things, because especially at the early stage of learning how to code, you would definitely need to refer to the codings that are built by the others. Well, it exists in multi-charts without being filtered and follow your computer when you install it, then I think they got a point why that code would still contain within the multi-charts, okay? So I think it's good. So do me a favor. Sometimes when you're trying to code something, and when you're stuck in the middle of your mind, when you're brainstorming, trying to look at the codes written by the others. Sometimes you will have the ideas how to write it or even how to improve your own code. So I think it's good. Right. This is one thing that I would like to say. And the fourth point would be parameters. And one point I just want to point out is when we do the takeaway gift, okay, we would write there's got two inputs, numbers, and some variables. What's the biggest difference between these two is when you're doing when you put those numbers into inputs, more like you can actually manually adjust those numbers. For example, today I want to use breakout of last 20 bars, but maybe tomorrow I use breakout of last 15 bars. It's okay for you just to manually input it. And also, there's one good thing if you use input is the numbers can be optimized. So use the optimization, as I mentioned in last two class. You can use that kind of tools to find the optimal or relatively stable profit-making parameters for you to use. And while variables cannot perform such things, just input. You can only optimize the inputs. You cannot optimize the parameter. You cannot optimize the variable. Okay, so that's one big difference between inputs and variables. Right. Let's talk about homework. All four requirements I list before. First one, I'll talk about those separate long and short. So just very simple. You just break it out into long and short. Then with a so-called close at end of day, will be very easy, right? I guess what I saw on the code that most of you would divide them into two parts. So I think it's okay. But also sometimes when you're trying to do optimization, when you divide them into two separate signals, would be easier for you to do the adjustment. So traders at my company, they would definitely separate those long and short entries, for easy maintenance afterwards. Okay. Second one, entry later than time, then you can do something like this. Okay, just after time. It's more like a condition. When the condition is fit, then we do something. When the condition is not fit, then the whole script of code will not be run. Okay. Third one, close at or close within the time period of, I've mentioned a few slides ago. Okay. And the fourth one, we'll talk about the MDD less than a certain amount. As you can see, the highlighted numbers would be the MDD. All right. Then there's got a few questions I ask you guys because I received an email from students about some settings of the code. When he told me when he tried to set the initial capital into $100,000, the performance will be much better than the $1 million as the initial capital. But can anybody tell me why? If I use $100 to trade versus initially if I use $1,000 to trade, every single trade I got the same result, same P&L, same profit, same loss. Then in terms of return in percentage, what would be the change if compared to two cases? One is I use $100, one is I use 1,000. Yes. Right. Yes, that's right. It's all about percentage. So when in $100 you make 10% of profit, all right, assume you just make $10 in one trade, then you get 10% of return. However, in 1,000 you just make 1% of return, something like this. However, this case does not just simply apply in profit. Also within the MDD, below the red rectangle, there's got maximum drawdown in percentage, 40%, right? So can you stand with 40.66% of MDD? If not, please increase your initial capital. All right, that's the reason why I asked you initially you have to use $1 million and try not to lose more than half of it. Okay, this is my requirement I listed in the homework. Yep, why initial capital matters. Return and risk same time because when you add more money initially to trade, your return will drop, but also the risk. Okay, in percentage, of course. All right. Then for the MDD less than the certain amount, actually there's few codes that you can use in your scripting, so help you to do it. The simplest one is just set stop loss at a dollar amount. It's the simplest. And also, if someone prefer to use how many points in the market, for example, one HSI points is $50, then you just use the big point value times 200. It will be the same thing. And also, if you use entry price, for example, your entry price is, let's say, 1,000 point, then the stop loss will be 800 points. Then you can write a script like the third one, okay? And also the max CD drawdown is basically the same thing. All right, you can use this so-called the built-in, some of the built-in or reserved words you can use. Okay, and of course you can think of your own codings. I saw some of you did it in the homework weeks. All right, takeaway gift. Today we will revisit the takeaway gift again because remember the topics of today's workshop is about the strategy report evaluation. So you have to have something to evaluate. Today we will utilize the result that generate from this coding, right? All right. Remember, we're trying to separate them into two different strategies. The one on the left is without exit, and the one on the right is you exit every single day. Okay. Right. Just one difference. Close at the end of the day. And there's got 4 categories of strategy report. If just like last lecture, if you guys click into the strategy report, you will see there's got some category for you to study it. All right. The first one we talk about is the strategy analysis. Okay. This is more like to give you an overall evaluation on the report. So you have a overall sense of how your strategy performed. First of all, would be the summary. All right. Let's move on to the summary part. Most of the time, we'll pay attention to these few factors that's few items that displayed on the summary. Net profit, of course, and gross profit and gross loss. You have to pay attention to that because you would definitely want to control if net profit over gross profit would not be such a very, very small amount. When it's small amount, which means more like you're doing a market making job. You just provide the liquidity to the market rather than you having profit. Okay. And also the strategy, the drawdown, close to close drawdown. The close to close drawdown would be definitely smaller than the max strategy drawdown because the max strategy drawdown is measured in each bar of your strategy. So assume the simple case is that you make money at the end of the day, but somehow in the middle you lose. Okay. Then the loss in the middle that actually will be recorded in the max strategy drawdown, while the close to close drawdown will not be included. Okay, that's a difference. All right, profit factor, just very simply speaking, is the gross profit over gross loss. It provides you with a very primitive way to see how your strategy performs because it's more like it is standardized. Just like in standard deviation, okay, you standardize something that is easier for you to measure. Most of the time, we will start with 1, of course, because bigger than 1 means your gross profit is greater than your gross loss. So you start to make money. Okay. And of course, this number is higher the better. But somehow, if these figures become very big, maybe sometimes 2 or maybe sometimes 3 or 4, and you have to pay attention to them because when you're trading, especially when you're trading the trend following strategy, okay, remember the principle of trend following strategy is what? We would encounter some loss, but we would control the loss in a small amount. And when there's a profit, we will let the profit run. So we don't know where's the end of the profit. We just let it flow until at the moment the market turns. Then you just exit. Okay. So you do expect to have a very large profit. Maybe occasionally happen, but when it happens, the profit is enough to cover all the losses, the consecutive losses that generate in the middle. So this is the way when you do this. So when you do this, you do not expect to remember if your profit factor is assume say very high, let's say 4. 4, that means your gross profit is 4 times bigger than your gross loss. Can you imagine what it's like? Well, if you build that kind of strategy and actually works in the market, trust me, you can just leave now. Just start trading and don't even waste your time to complete the program. I mean the USD course. Don't worry about it. Right? You don't have to graduate at all. Because when you can trade something like this and actually make money, and as long as if it's long-lasting, then you definitely be very rich. Okay, so there's one point I'd like to add. It's just can you see the adjusted net profit below the gross profit and gross loss? Basically, the terms adjusted means more like the worst case projections. The multi charts will do some calculation for you, and the selected profits means it deducts the P&L outside 3 standard deviations. Okay, so more like that. Also trying to give you an impression of your strategy. Assume that when some of the profits or some of the loss got taken away, how would the result of your strategy be like? Okay, so you can compare the close at the end of day and without the close at the end of day. All right, so let's do a little comparison here. As you can see, well, net profit seems like with the close of end of day is higher, right? And also I can see the maximum strategy drawdown seems like, wow, much lower. Okay. Profit factor, similar, but also pay attention to the commission. Remember the last lecture we talked about the commission. When you trade without at the end of the day, so basically when you encounter a bad market, you just close the trade, okay, no difference. But however, when you encounter a good market, which is suitable for your strategy to make money, then you just hold your position until the market turns, all right? So, however, at the end of, with the close at the end of the day, you will still liquidate your position. And another day, if the trend continues, then just open it, reopen it, then close it at that day end as well. So that would make a difference in the number of trades as well as commission. Just like I mentioned last time in the class, if you trade very frequently, actually, well, you just like work for your broker rather than work for yourself. Okay, because you generate a commission, you can see how many times of commission that you generate over a period of time. Okay, then the second one in the category would be the time analysis. Actually, the time analysis just give you some information about time, especially the percentage of time in the market. For example, in the example that we use, the takeaway gift, they got 15.07% of time in the market. Well, this is the figures that you have to pay attention to, because try imagine if your strategy is either go long or either go short, right? Very simple. For example, those moving average. If you just use simple moving average to do the long trade and short trade without any kinds of stop loss or exit, then probably your percentage in the market would be close to 100%. Because in the market, any time you either long a trade, or have a long position or a short position, all right. But however, in trend following, we're trying to minimize those this number. I guess within 20% to maybe some market will only be 10%. It's because when you're trying to do trend following, trend does not always happen in the market. So more likely the market moves sideways and well, some news come out or something's come out or just a lot of hot money flow into the market, then the market start moving. We hope to only to trade the market when the market start moving. Of course, sometimes you lose, right? Because when the fluctuates, you lose. So if your strategy tells you that you got a loss of percentage of time in the market, then probably you have to think about your trading strategy, especially the entry condition. Why would I have to enter the market so frequently and I have to stay in the market for so long, right? Is it possible for you without staying in the market for so long, but you still make the same profit? You have to think about it, right? So because the main point of trend following is just you trying to capture when the trend comes in, rather than just stay in the market and wait for the trend. Okay, it's different, right? Counter trend strategy would be more like a not exactly opposite side, but I think is just like doing the opposite way. You hope the market would continue to be continue to fluctuate a lot. So if the market continue to fluctuate and within the range that you can predict or estimate it, then you can try to catch those very low point to buy and catch those very high point to sell. More like a dream, okay? If you keep doing this for few trades, then you feel like a god. If you do it manually, right? I can capture few lowest of the wave and I sell at a few highest of the wave. Then I guess I'll be a god. Quite often time people would have this kind of feelings. When where can you find? Just go on Facebook and search for those calls who tell you who claims himself to be more like trading god and makes a lot of money all the time. Okay. Then you have to use this report to locate when it happens to be the maximum drawdown. Because when you it tells you when you observe this time frame and the specific date and time that mentioned here, look back in the graph and see what is going on. you have to revisit your trading strategy in the graph, because when it happens, you can look into your scope. Well, somehow right now just generate some loss. For example, if I generate some loss, that happens just within my limit, and also I have considered this kind of situation. If occur the loss, then I have to accept it. But however, when you see a great loss, somehow you don't know why, and somehow you didn't think about it, you didn't anticipate for you to think, oh, maybe something that I overlooked, I didn't think about when I trying to do the scripting. Okay, so that's one way to remind yourself to keep learning. All right. Then of course it will help you to evaluate the best and worst situation. On the MPD will be the worst, and the max run up date will be the maximum profit. So also you can see during that period of time, at which point, under what circumstances your strategy will make the most profit, and under what circumstances your strategy will make the least profit, or sometimes the greatest loss will generate. So it's more like a mirror for you to look at your strategy inside out. All right, not just evaluate the best part, also the worst part. Okay, and now we look at the strategy analysis. Another part is called the equity curve. Well, if you ever try to click into the strategy report and click on the items that are available for you to check on it, there's got a lot of charts for you to look at it. Most important, you have to differentiate these two charts. Is one, the x-axis, one would be date, so more like time based, and another would be based on number of trades. So most of the time, these two charts will look very similar. However, if your trade only occurred once a year or twice a year, those very infrequent trade, then the right hand side would not be very smooth. However, left hand side may be smooth because you just record the equity high and the equity low during that period. You can see most of the colors here are in red, right? So also, if you look closer, there's got some green lines lie on the same place. Just overlap with the red ones. So it tells you within a day you have the precision, you have the within a day the maximum profit that you can make, the floating profit that you can make, and the losses. All right. And the next one will be just simply showing after each trade, would you make money or not? Right. Those green dots are telling you about the point that you make you just achieve another equity peak. You just have a higher level of equity curve. So, which is a good point. Let's see if I got any example to see. Or maybe afterwards we'll see another one with quite continuous green dots, which is good for you. You assume, oh, maybe if I have a strategy like this, then it's just the market is more like an ATM for me. I just keep withdrawing money from it every day. All right. And also, there's one point we have to add. Why we have to divide those strategy into long side and short side is because when you divide strategy into long side and short side, equity in here you can see the equity curve detailed in long and detailed in short. So you can refer to the separate equity curve from the long side generated or short side generated. Sometimes when you enter a market, when the market is not fluctuate like this, okay, this is HSI over a period, the same market data I gave you. However, if the market just move in one way, for example, just keep going up like the US stock index, then you would not expect your short side to make money, okay? Right? Does that make sense? If I'm a trend follower, when the market keeps rising, do I expect my short side would make money or not? No, right? How about the long side? I expect the long side would make more money, right? So sometimes it's more like a trade-off. You have to consider when you find a market that with a upward trend, then you just apply those strategy, the long strategy on it. Okay, the short side strategy. Sometimes you may see in the report the short side will be losing money. However, the long side make a lot of money. Then you have to think about, is that my strategy wrong, or just the market is just like this? Okay, this is one point for you to consider. All right, buy and hold return, very simple. As I just mentioned, it's more like a benchmark of the market. And Rex, would you like to add a point? If your return is lower than the buy and hold return, will you still trade it?
return is lower than you put the money in bank. So what is the payment for returning your trade?
Right. So you have to think about it. However, also I'd like to add one point is that consider the buy and hold return. You also suffer from the MDD of this buy and hold chart. Okay. So just like you long position and you just put it away for 10 years. Of course, during the midway, you still encounter those unrealized profit or loss. All right. So basically, you can see if this is a long side equity curve. Assume this is your equity curve. Then you have a very big drawdown. Will you satisfy with it? You have to think about it. So you have to think about when I compare my strategy, the result of my strategy compared to buy and hold return, you have to think about if you're willing to accept that kind of MDD as well.
Talking about my technical, but this chart may help you guys to, because last time Henry let us introduce the trend mode strategy, and as we all traders do know, there is trend mode or we call cycle mode of the market, because trend mode is just like, as you can see at the, I think it's the end of 2016, right? Start from 2016 and up to now, it is obviously in trend mode because it's trending up. It keeps trending up. And this graph will show you, because if you apply a trend following strategy to the market, in this situation, you will make a considerable amount of profit. But what if you are using a cycle mode strategy? Because it's more like a mean reversion. If you are using a mean reversion strategy and you lose money in these 2 years, and you look at this buy and hold, you will know what is the mode of the market at that period of time. So if your strategy are losing money, don't be afraid, because you know why your strategy will make profit. And the market did not follow what you want it to be. So it is sometimes some traders or coders, they will think their strategy is
somehow inactive.
Somehow it worked in the past, but it doesn't work anymore. But it is just because out of sample, because your test is all in sample. But if you encounter some out of sample situation, then don't be afraid. Just don't be afraid. You need to look at the buy and hold return. Actually, it's the chart of the market, so you will know when your strategy will be working.
Right. Thank you, Forrest. For his comment, and also there's one point I'd like to add at the end. That's why at the beginning of the last lecture about trend following, select the product or market is more important than selecting the strategy. As Rex just mentioned, if you are in the long trend market period, well, just don't use your brain. Use the very simple long way swing strategy to capture the return. Because in a trend mode, the market in the trend mode, just use those trend strategy. It shouldn't perform worse. It shouldn't perform worse than you expected. You should just make money. It's just a matter of the risk that you are taking or the leverage that you're trying to impose on it, right? Okay. Well, second thing would be the trade analysis. Well, this part is quite simple. You just look into the trade-related information that tells you. For example, the first one will be the list of trade. Very simple. You just have to refer to those entry and exit point. It will tell you the time and the date, and whether the signal will be a long entry or short entry. And of course, you can write your own description on those long trade. For example, if I use breakout entry as for long side breakout, it's okay. I use it. As short side breakout, I use it. When I use the exit, maybe sometimes I just use it's whether it indicates it's a stop loss, it's a trailing stop, or it's just end of the day, then I'll just exit. Okay, so just help you to identify those trades. And of course, you can see the profit, the accumulated profit, run up and the drawdown, all listed. All right, don't worry. The homework of this lecture would be something related to this list of trade. The next homework, right? Then the next part, total trade analysis. Quite often time we will look at these few highlighted in red numbers. First of all, number of trade, of course, it's very simple because you want to ensure you are not overtraded, so you are not working, you're not somehow working part-time for your broker. And also if the number of trade is not too small or too little, because when you have only, let's say, assume in the last, I give you 10 years of data, you only generate 10 trades, then how should I trust you that your conclusion will be statistical significant, right? So you have to think about it. All right, the percent profitable is more like a winning ratio. Okay, we just call it winning ratio. It just show you how many percent of trade are making money. All right, we're not mentioning about the scale or the magnitude of the money that you make. Just telling you it makes money or not. Quite often times, a trend following would be somehow less than 50%. But there's got a rumor. I don't know why. Just people in the market would do this. If they assume that if I flip a coin, I got 50-50 chance, right? If a trade strategy that makes money less than 50%, why should I trade that strategy? Right? Actually, it's more like you have to look into the next item. It's called average trade, because when you're trying to make money, the ratio of average trade, we should be referring to average win over average loss, because when now the figure is 2.55. So when you lose $1, all right, when you win but you lose, when you lose $1, but when you win $2.55. Then you can calculate what is the break-even percentage. Assumingly, if you're having a profit-making strategy, then your percentage should be higher. Okay, that also answers the questions why, if you have a trading strategy with less than 50% of probability, I can win, I still trade it, because yeah, you lose $1, but when you make money, you make more than one. Okay, that's the point of it. And the average trade is also very important, because the average trade would be indicating the P&L you can generate per trade. Of course, right here is a profit in long run. In long run, it's very important, because in short run, of course, if you just trade 10 times, you will not achieve, quite likely you will not achieve these average figures for every single trade, because sometimes you win, sometimes you lose, right? But however, we're talking about in long run. Let's say you run it for maybe 5, 10, 20 years. Then you would, if somehow your strategy is quite robust and you can trade in the market for a long period of time, then quite likely you can achieve this kind of level of profit. And also, this is a profit for you to evaluate. Let's say, give an example. If I trade very frequently, I only make $100 per trade in Hong Kong HSI market. Okay. However, the HSI market, we're talking about each point would be $50. So the profit that I made only 2 points in average in long run. If somehow I encountered in a situation is that the slippage you pay, maybe sometimes it will be more than more than 2 points already, because if 1 point of slippage occurred, there's already a loss of $50. All right. So you have to estimate how many points of profit that actually you made in the average trade. You have to, in the trend following strategy, is quite obvious. It's got relatively big amount compared to the $50 per point. All right. So that means, because you're not trading quite frequently, so that means even if a slippage occurs, it shouldn't take away your profit for too much. However, if you trade those counter trend or swing strategy or mean reversion strategy, quite often times you make money in a lot of time. So your winning ratio will be very high, but however, the average profit per trade will be very low. And at that circumstances, if the market somehow become illiquid, then you just lose your money. You're not losing the money to the market. You just somehow lose the liquidity. You just lose the money to those slippage. All right, so this is one thing that you have to pay attention to. And also you have to pay attention to the last one I highlight in red is the largest losing trade. So somehow just one trade generate a loss of like 62,000 something. So it's relatively a big number. And why is that? Well, look into the graph. Why or when did it happen and why did it happen? Maybe it's a coding error. Maybe it's your data is incomplete. It sometimes happens. You just check on the time of the bars. Like maybe in the middle of the day, you just get 10 bars missing. Don't know why. Sometimes it happens like that when you use those historical data. You have to check on this number. So just to ensure that is also a reason why in the beginning of this workshop I told you that the input will be very important because you use good data, then you have relatively trustworthy result. However, if you use those bad data, maybe it's free. Yeah, I understand. Free data is quite attractive to me. I don't have to pay extra for the data. But however, if you use bad data, sometimes you just affect your figures on especially those P&Ls. Because right here we're talking about making money. However, if that's the case of great win, then I'll just leave with it because I assume, because I'm smart, then I generate a strategy like this and I should make this money. I can claim this money. All right. But however, it's just due to an error. All right. And also in the list of trade, you can refer the graph. You can select just like I highlight here the largest losing trade in percentage. Then you can see that trade that generated most loss. And refer to the chart just like in the above, then you will see, what happened in that day. Actually, within this case, we're talking about somehow, I don't know why, in the middle of the day, within the trading hours, somehow it just have a very deep gap down in the market when you're having a long trade. When you're having a short trade, it just somehow gap down and just rise up in a very short period of time. Then you just exit your position, generating this kind of loss. So when you see this, you have to think about if that day I was in the market, then how should I trade? Is that normal? In my codes, when I code my strategy, did I take this into the consideration when I'm trying to do the codings? This is the reason. This is the point that you have to ask yourself. All right. So this list of trade is quite likely it's the function as a table for you to look into those trades. You find those very suspicious trade and you can refer to it and see if it's normal or it just somehow I overlooked this opportunity or maybe from this point I can generate another trading strategy as well. All right, this is also a way for you to think about it. And this part would be more likely the most difficult part in today's workshop because we're talking about the distribution. All right, in distribution, in traditional finance, we're trying to have a highest Sharpe ratio. Anybody didn't know the term Sharpe ratio? Okay, good. All of you know what is Sharpe ratio. Sometimes Sharpe ratio is talking about you expect to have least uncertainty and you have a steady income, more like income flow. So what product you trade would have, or how would you have the infinite number of Sharpe ratio? All right, you're just talking about something without loss and you make money every single day. Even treasury bond is not the highest. It is how to say? Yeah, basically there's no products that can guarantee to give you the highest Sharpe ratio or infinite Sharpe ratio. Well, in my thought, I think it's more like if you go to work, if you get a job, right, you don't have to pay your company, so you have no loss. You just talk about your gain will be big or small. Okay, then in the formula you have infinite Sharpe ratio. However, this is not the real case, especially when we're talking about in trading. It's because in standard deviation, you can think about, in the distribution, we're talking about the standard deviation would be more like both sides, taking both sides, numbers of both sides into calculation, right? In the left-hand side would be our loss and the right-hand side would be our profit. In the left-hand side, we're trying to limit our P&L, the loss per trade. We're trying to limit the loss per trade. So within the money losing side, you would expect the standard deviation to be very small, right? Because every time when the loss is occur, you expect to end the trade within your acceptable levels of loss. So that's why you set stop loss, all right? However, when you're winning money, you're not so sure. Or I'll talk about in trend following. You're not so sure about the eventually what the P&L will be like. Right? Of course, the profit bigger the better. So I just assume, hopefully the standard deviation of the profit making side, the higher the better, or the bigger the better. Okay, this is a point that I would like to add. So if your trading strategy is a very typical trend following strategy, you should have a distribution like this. All right. You will have a fat tail on the left as well. You will have a left fat tail on the right because the profit, I'm not so sure. I just hopefully get bigger the better. However, on the left hand side, you're trying to limit the loss. So you have quite a high probability of generating a loss that, left hand side of the zero, so it's a loss, right? You would expect, maybe, especially in the loss, please no fat tail because I don't want to lose a big chunk of money. Right? I just expect to have a big chunk of profit, not a big chunk of loss. All right. So if your trading strategy is a typical trend following strategy, when you plot your let's say per trade P&L in the distribution, you get distribution chart like this. Okay. Then actually it reflected the fat tail features for the profit distribution is on the right hand side. The skewness to the right hand side is also showing a low winning rate because you can see the mean I assume the mean or the mode of this graph will be quite often negative. All right, it's the left hand side of the zero. All right, so actually it means low winning ratio, limited loss, and also fat tail profit. This is what you're trying to when you're trading trend following trading strategy. Okay, and this part, if you understand, which is good. If you do not understand, don't worry. We got some charts in the strategy report that can help you. All right. So again, strategy to quite a lot of trade. While on the right hand side, I only got few. But however, pay attention. Black dots doesn't mean anything special. Just average win, average loss. Sometimes you win, sometimes you lose. As long as they are within some limit that I set preliminary, that is okay. However, when you look at those red dots, all right, maybe on the right hand side, red dots, as you can see, the maximum red dot, the lowest red dots will be somehow 60,000 something, should be equal to I have mentioned before this trade, 60,000 something. Okay, then you would expect you have some losses, but you have somehow controlled your losses. Okay, sometimes you will have some outliers occur. For example, if you trade, I just don't know why. Maybe it's due to data. Maybe it's due to somehow the market when it opens in the afternoon, somehow it just suddenly drops or suddenly rise like crazy. Then I don't even have time to close my position in time, so I generate a loss that bigger than my initial stop loss value. Right? It happens like this. It's called outliers. And also the green dots will be the profit that you're trying to achieve in just like in the last chart. The right hand side profit, you expect to have a fat tail, right? Okay. Then this more like a standard one. And of course, this strategy is not perfect because if it's a perfect trend following trading strategy, you expect the red dot should be limited to, let's say, negative 20,000 without any or very few outliers. However, on top of the graph, you expect a lot of green dots just scattered on the upper part of the graph, which means I got a loss of flat tail profit. I don't know the amount, but just got a loss of flat tail profit. Then you can expect that trading strategy would have a relatively good performance in the strategy report. All right. So this is also one way for you to evaluate those distribution, and also you can compare the same strategy. If I close every single day, it will happen like this. If I do not close every single day, it will happen like that. Then you can estimate how good or bad your strategy would be. When you look at the x-axis, okay, especially on the right the chart on the right hand side, you can see there's a few red dots within maybe 50 numbers of trade, and during the 450 number of trades. Actually, it is more like during the market period, the market moved quite drastically. Right? Somehow it just encountered some outliers. For example, in the year of 2000, I'll give you the data 2007. Okay, in 2015 or 16 should be just like this. The market move quite crazily. Then you will have some outliers. Of course, if the outliers is profit, they'll be good. But however, if not, then you have to think about how to control your maximum loss. All right, and also during the year of 2007, maybe during the year 2015 will be something like this. Okay, so you can refer to your chart to see which period of time would give you the most profit, also the maximum loss. Okay. And next one, trade series statistic. It's more like telling you about the consecutive losses or profits. So if you can see here in the winning trade series, it occurred only once for 6 continuous profit trade in a row. Okay. And however, in the losses, I just somehow find that there's got once happened for 16 continuous losses. So when you look at these numbers, okay, within the sample, you can expect the worst case of continuous losses. Well, I'm not so sure how much, but somehow it can happen to be like 16 continuous losses in a row. So when you really trade in the market, during the first 3 trades that you're losing money, maybe you're starting to lose your confidence. How about the 6th time? How about if you get 10 continuous losses? How about 15? Well, maybe you would just quit and stop your trading strategy from running anymore. However, in the market, just tell you that if you use the same strategy in the historical market, you can see it happens once or 16 times already. And theoretically, in long term, these figures or this 16 times, this number should not hold, because in the out of sample data that, of course, you should encounter more of it. All right. So at a point, maybe if you can see in here, once happened to have 16 losses in a row, maybe at the point I really encounter 16 losses, should I stop my strategy? That's a question that you have to think about. Because when you're trading, actually, every single minute you are dealing with some out of sample data. When the data are out of sample, then do you expect to have stay for yourself, right? This is like a contingency plan to protect your capital. Okay. Oh, also the 16 consecutive losses. Can you withstand it? That's one question. Another is, will you consider to add position if you have consecutive wins? For example, if the first trade I make profit, second trade I make profit, and the third trade I make profit as well, I'm not so sure how long can it last, but will I double my bet or maybe add 15% more of my bet? This is one thing that you have to think about, and it's something related to so-called position sizing. Don't worry, it will be covered afterwards. But I can tell you, more likely, position sizing is evolved from gambling in casinos. There's some mathematical explanation in each of the way to deal with it. For example, this Martingo actually is a betting system that people invented it back in, I don't know, maybe 19 or 18 something, I'm not so sure. Just like many years ago. And of course, they invented this kind of strategy from the stimulation of when they're trying to place a bet in the casino. All right. And of course, there's got some changes during the time because, for example, in casino, when you bet, 買大細點講先 bet on big, is it called big or small? 買大細有冇人知買大細 ？Rest. Do you know what is 買大細? How to say 買大細 in English? All right. You just bet 3 dice. The total number of the dice would be more than 15 or less than 15. Around that, I'm not so sure. I'm not a good gambler. But yes. So during that case, when you place $1 bet, when you win, you get $1 back, right? So the average trade per profit, average trade will be $1. However, in trading, it's different. So you have to adjust your your formulas when you're dealing with it. Okay, don't worry, it'll be covered afterwards. So just stay tuned. Reserve your evening for each Wednesday. It will be covered afterwards. Okay, then we just move on to the periodic analysis. In periodic analysis, actually, there's not much that we have to talk about. It's just telling you the performance over the time, especially when you can see in monthly basis. For example, if I got or if I invest, I see a monthly return like this. Because most of the time, if you are operating a hedge fund or some private fund, you have to disclose your monthly return to your investor. Okay, more likely you will put on those newsletters and issue to your clients saying that, oh, okay, in the last month, how did I perform? Maybe I perform good, maybe I perform bad for some reason. You have to explain it. And this is the figures that you have to pay attention to. For example, you make money sometimes, you lose money sometimes. I think it's okay because quite often times when you make money, those figures are relatively big, and when you lose money, you just talk about few thousands. Okay, maybe 7,000 is quite big sometimes. So you have to think about if you want a strategy that is you make profit for every single month, then maybe you have to look for some strategy with higher winning ratio, like those contrarian strategy, mean reversion strategy or swing strategy. It's because you can see the patterns is I try to make money. I try to make money quite frequently. However, each time the money I make will not be big. All right, then quite likely you got a very satisfying result here. You'll probably see you make money, or you make money not in every single month, but most of the months you will make money. I think the investor will be very pleased because from the perspective of the investor, they're just trying to make money regardless it's big or small. Quite often time we encounter investor like this. In trend following strategy, quite often time you have to anticipate some loss or continuous loss. For example, continuous loss for 3 months in a row. Can your investor stand with it? You have to think about it. If not, you have to think about if that investor is a good investor for you. Maybe you can have another trading strategy or another portfolio is contain those mean reversion strategy. Then you can just refer him to that portfolio. Okay, it's also one way. So when you do this, is there any problem in long run? Sometimes you win, sometimes you lose. Is there any problem in long run? No? Right. Is something related to compound interest, right? As actually, compound interest is one of the most very powerful weapon on earth, I guess. When you keep making money, regardless it's big or small, you just reinvest it, right? So when you reinvest your money, even if it grows in the same percentage, you will still get more in terms of amount of money. You still get more money. But sometimes if you win, sometimes you lose. Quite often time, investors would not like it because they really want to find an ATM machine in the market rather than sometimes you big win, sometimes you have a small loss, that kind of things. So this is one thing that you have to pay attention, especially if you afterwards want to step into the financial market in maybe front office or selling roles. Then when you talk with your client, you have to pay attention to this part because quite often times it will be the needs, one of the needs of your client. Okay, I'll move on. Annual period analysis. Well, just change monthly to annual actually per year. As you can see, in year 2011 and 2013, this strategy lose money. All right, and also somehow I don't know why in year 2007, well, we make 100% of return. Oh, impressive, right? This is also one thing that I have to ask you to think about in long run. Would there be a problem if initially I trade, okay, all those figures are generated from when you're trading one contract, okay? Regardless, you have $500 or 5 million, you're still trading one contract. So initially when I trade, because my base capital is very small, then quite easy for me to have 2 digits of return, okay? However, in long run, maybe afterwards, you might not be able to generate the same percentage of return for your investor or for yourself. Well, how should we deal with it? You have to think about maybe initially I only got 1 million, and of course I trade one contract. Maybe some days when you make 2 million or 3 millions, then will you consider to add up your bets? maybe you should trade 2 lots or 3 lots or even 10 lots. Okay, you have to think about it. And also, there's something that related to the risk and reward. So if you increase more bet, of course, quite likely your return can be boosted up. However, your risk will also boost up as well. So you have to think about it. Actually, there's some mathematical models can deal with this kind of problem. It will be addressed also in the later of this workshop would be the position sizing part. So don't worry about it. However, I want you to have a mindset, have this kind of mindset is if I got $1 million in my pocket, I would trade maybe one product. Each product I can only trade one lot. However, if you get 10 millions or 100 millions, will still be the same. You have to think about it. And this is the problem when you can see on the market those figures of those results of hedge funds. Okay, quite often times hedge fund will generate a big return, but when you look at the AUM, the assets under management of those very well performed hedge funds, the AUM will be relatively quite small. However, if you look at those very big funds like those big names, Fidelity or any other big names of those funds. Yeah, I only can think of Fidelity. Yeah, that kind of multi-billion dollars fund, you would not expect to have a double digits of return each year. Okay, so that's the difference. And of course, it's related to risk. I'm not suggesting small fund would have higher risk than those big fund. I'm not suggesting that. I'm just talking about the utilization of capital. Okay, because it's different. All right. All right, settings. Right, setting is just brief capture of screen of the parameters and inputs that you will use. For example, in here, I name it HKUSD takeaway gift. Okay, I guess you guys knows what strategy that I'm talking about. The periods and the filter will be 10 and 100. They are inputs. So as I mentioned, inputs can be optimized. Afterwards, go back home. You can or go back to the dorm. You can actually try to optimize it. And let's see, within the data set I gave you, you use maybe more like 10 years of data. When you try to optimize it, let your computer run for a while. Hopefully, it will not burn. And you can see which two parameters will be the best for you to generate the net profit. Or you can play this kind of game. It shouldn't take too long, maybe just 30 minutes or something, so you can try it. And this is one way for you to memorize the trading strategy, because quite often time when you have more than 10 strategies, I'm talking about combine both long side and short side. When you have more than 10 strategies, quite often time you would not remember the input that you use in the strategy. So somehow you cannot generate or regenerate the strategy report that equals to the previous one. And when it happens to me, I have to explain to my boss why the figures are different now, even with the same set of data that I use. All right. Okay. Also, there are other settings. For example, the initial capital I have to use and the commission and the slippage setting. This is also the part when you guys hand in your strategy reports. I have to look on it. I have to see those commission and slippage are set in reasonable numbers. All right. And there's two things that are quite interesting for you to read. One is the interest rate. As you can see, the interest rate are set to 0. Why? When we trying to develop trading strategies, okay, first of all, we divide them into long and short. Okay, why would I have to consider the interest rate in traditional finance? It's quite often time because CAPM model suggests we would have, if we just keep our working capital unused, then I should generate the risk-free rate in the market when in the bank deposit, right? But however, in the case when you can trade in the long side and also short side, right? You can imagine if in the CAPM formula, if the market drops, you should lose money. Okay. However, this is not the case if you are trend following traders, because when it drops, somehow maybe you'll be more happy than the others because you make money when the others are losing money. Okay, trust me, that feels very good. All right. Then also the compression of time, which means more like the time frame that you use. Point value $50 each. Then you can see all those informations that you would have the later on it. So quite often times when you think you have developed a satisfying trading strategy, okay, do remember to check on the strategy report and also export those reports in Excel and save it down, because afterwards, quite often time you have to refer to the data back in it. So it's easier for you to dig into the data in the Excel rather than on the multi charts. Okay. Right. More dimension to trade. This is talk about when, for example, right here, the product that we trade is called HSIF, right? This is one product. So what do we trade? Actually trade the price of it. Okay. However, actually we do not just we can trade more than just the price, one price of the product. We can trade of the relative price of a product. For example, quite often time in some hedge fund doing in equities market, they will do that. When they select industry, okay, maybe in one industry, they got 5 companies that they are listed, then they can be traded. And quite often time they will do some research within that industry, and I will long the strongest stock in that industry, and I will short the weakest one in the trading strategy in the industry. And I expect to have relative return, because when the strong one keep becoming stronger, I'll make money. And also, if the weak one keep decreasing the price somehow, I don't know, maybe some bad news or anything, then I'll make money. All right. However, your beta will be adjusted. So quite likely to say is, even if the market goes up or down, theoretically, it shouldn't affect the portfolio, affect the P&L of your portfolio a lot, right? So this is the idea. So you can assume it's like more steady and stable market for you to trade if you're trading the relationship between 2 prices. For example, I assume when Japanese market goes up, Hong Kong market will goes up as well. Okay, this is my assumption. When I do some back testing, I found this. Oh, okay, seems like. Then I'll just trying to apply a strategy on it. When Japanese market rise, because Japanese is 1 hour ahead of Hong Kong. Okay. When Japanese market rise, then I'll just buy the Hong Kong market. All right, this is the trading strategy that I can think of the simplest way. All right, I can do it manually even, right? If you are watch on computers or on the internet or on the TV, somehow I see Japanese market rise more than 1%, then I'll just long Hong Kong market. Okay, trying to catch up with that. The spread would not be too big. And however, in multi charts, you can do it more in advance, because actually in multi charts there got some features that you can real-time reference to the price of 2 different products and calculate. You can just use your coding to calculate the difference of the price. So the prices is more like become the relative price. For example, the difference between Japanese market and the Hong Kong Hang Seng market should be 10 points. So when this spread in average is 10 points, when it becomes 20, then I just long one and short another one. It's totally okay for you to do this. Okay, so basically you have no beta at all, theoretically. Okay, this is a way to trade. So you can see there's more than just a dimension you can trade. If you trade just price, you have different strategy. Okay, you have trading strategy, you have trend following trading strategy, you can have counter trend trading strategy, or you can have mean reversion. However, you can look at more than just one price of the product. You can look at the price of the difference of the products. So you have the relative price to trade. Also, the different time frame you can refer it. When we do it in multi charts, more likely we do it in a so-called statistical arbitrage, because quite often time you will use your strategy report to see if the results are good, and you would optimize input numbers for you to have hopefully to have the best result. Then use this kind of math and statistics approach, so you can trade the relative price of 2 brokers. All right. This is also the topics of the next Wednesday, would be called the statistical arbitrage trading strategies. All right. So till here, I've talked 1 hour and 15 minutes. Is there any problems? All right. No. Well, that'd be good. Well, at least to night, you will still have your chance to touch with those. Yes. Insignificant. Right.
How do we quantify too many or too little? Does it have to do with the time frame, the backtesting period, or how do we quantify?
Yes. quite often times when we try to develop a strategy, we will use more than 10 years of data. Okay, so you can just simply think of, I can evenly divide it into 1 year. How many numbers of trade will I occur in a single year? For example, in here, if there's a assume I use 10 years of data, then each year I should around 60 to 70 trade per year, right? So each year I anticipated 252 trading days. Then more likely I would have maybe every 4 to 5 or every week. Yeah, maybe 4 to 5 days for one trade. So quite often time I expect if in this market, if a trend somehow a trend occur, that trend maybe last more than 3 days, then I think maybe one trade or 2 trades a week is okay. So this is the perspective you can try and look into the problem of total numbers of trade. However, if I tell you it is a trend following trading strategy, somehow I generated 10 trades a day, 1 day. Do you expect within 1 day in average would have 10 different trends that you can still capture? Then you will think of that numbers yourself. All right. So it is more likely one factor is the length of the data that you use, and the second factor I would say is nature of the strategy that you use.
The frequency of the trade affects the numbers.
Frequency of the trade affect the numbers that you will see.
If I intraday, over a few days or few weeks.
Well, actually, I think there's a trade-off. Quite often times when you refer to the data, for example, if you use 10 years of data for you to do the backtesting or you're constructing your trade strategies, try to pay more attention to the result that generated in the last few years, because the markets would from time to time. All right, quite often times if you perform questions, okay, like this. Now it's year 2017. If I give you a record like this, will you trade this strategy? Will you? Right? Still same thing. They trade all in one unit. So you can see sometimes it makes big profit, sometimes it makes a relatively bigger loss for 1 year. So you have to explain to investor or to yourself why that year couldn't make money. Although the percentage is not that big, because in the last year you make 26%. You lost. I think it's okay. So back to your questions. If I were to, I will look close to the last few years. For example, I will look closer to from years 2015 to 17. I see. Okay, money. However, the fix of the money
re-established
would have been like, or even or you have to. Okay, so I can tell you there's no absolute answer. It depends on the time frame that you use testing and also nature of your training.
Connecting. Connected.